Global Institute learners. I'm genuinely excited to see you here for another engaging session. Today we begin Chapter 1, Employee Benefits, focusing on the application of IAS 19. This is a core standard at CPA Advanced Level, and one that requires you to combine conceptual clarity, numerical accuracy, and disciplined presentation, exactly as expected in the examination. Employee benefits represent obligations that arise because employees provide services to an entity. These obligations are often long-term, uncertain in amount, and dependent on assumptions about the future. The objective of IAS 19 is to ensure that the cost of employee benefits is recognized in the period in which employees render service, and that any related liability or asset is measured and presented faithfully in the financial statements. At advanced level, the standard is particularly important because it forces candidates to explain not only what is recognized, but why it is recognized in profit or loss or other comprehensive income. IAS 19 classifies employee benefits into 4 broad categories, and this classification drives the accounting treatment. The first category is short-term employee benefits, which are benefits expected to be settled wholly within 12 months after the end of the reporting period in which the employee provides the service. Examples include wages and salaries, paid annual leave, bonuses, and non-monetary benefits such as medical cover. These benefits are recognized as an expense as the service is rendered, with a corresponding liability if unpaid at the reporting date. Measurement is straightforward and does not involve discounting because the settlement period is short. The second category is post-employment benefits, which are benefits payable after employment has ended. These commonly include pensions and post-retirement medical benefits. IAS 19 makes a critical distinction between defined contribution plans and defined benefit plans, and this distinction is frequently examined. Under a defined contribution plan, the entity's obligation is limited to the contributions it agrees to make to a separate fund. Once those contributions are paid, the entity has no further legal or constructive obligation. The accounting treatment is therefore simple. Contributions for the period are recognized as an expense, and any unpaid contributions at the reporting date are recognized as a liability. There are no actuarial assumptions, and no long-term obligation remains on the statement of financial position. Defined benefit plans are significantly more complex. Under such plans, the employer promises a specified level of benefit to employees, usually linked to salary and years of service, and therefore bears both actuarial risk and investment risk. IAS 19 requires the entity to recognize on the statement of financial position the net defined benefit liability, or asset, calculated as the present value of the defined benefit obligation less the fair value of plan assets. This immediately introduces estimation uncertainty and professional judgment, which is why defined benefit accounting is a major focus at CPA Advanced Level. The defined benefit obligation is measured using the projected unit credit method, which attributes benefit entitlement to periods of service. Future cash outflows are discounted using a high-quality corporate bond yield at the reporting date. Plan assets, on the other hand, are measured at fair value and represent assets held in a legally separate fund that can only be used to pay employee benefits. Understanding the interaction between the obligation and the plan assets is essential for both computation and explanation. The cost of a defined benefit plan recognized in the financial statements is split into 3 components. The first is service cost, which includes current service cost arising from employee service in the current period and any past service. Cost arising from plan amendments or curtailments. The second component is net interest, calculated by applying the discount rate to the net defined benefit liability, or asset, at the start of the period. The third component is remeasurements, which include actuarial gains and losses on the obligation and the return on plan assets excluding amounts included in net interest. IAS 19 requires service cost and net interest to be recognized in profit or loss, while remeasurements are recognized in other comprehensive income and are never recycled to profit or loss. Past service cost arises when an entity introduces a new defined benefit plan or changes the benefits payable under an existing plan. IAS 19 requires past service cost to be recognized immediately in profit or loss at the earlier of the date of the plan amendment, or when related restructuring costs are recognized. Curtailments, which significantly reduce future service or the number of employees covered by a plan, are treated in the same way. This immediate recognition often surprises students, but is a common examination point. IAS 19 also addresses other long-term employee benefits, such as long service leave, jubilee awards, and long-term disability benefits. These are accounted for using a method similar to defined benefit plans, but with one important difference: remeasurements are recognized in profit or loss rather than in other comprehensive income. Finally, termination benefits arise when an entity decides to terminate employment before normal retirement, or when an employee accepts benefits in exchange for termination. These benefits are recognized when the entity can no longer withdraw the offer, and measurement depends on whether the benefits are short-term or long-term. To consolidate these principles, we are given a CPA-style examination question involving Delta Limited, which operates a defined benefit pension plan. At the start of the year, the present value of the defined benefit obligation is 400 million shillings, while the fair value of plan assets is 360 million shillings, resulting in an opening net liability of 40 million shillings. During the year, employees earn current service cost of 28 million shillings. Contributions of 25 million shillings are paid into the plan, and benefits of 20 million shillings are paid out to retirees. The discount rate at the start of the year is 10%. During the year, an actuarial loss of 15 million shillings arises on the obligation, and the actual return on plan assets is 32 million shillings. Applying IAS 19, net interest is calculated on the opening net liability of 40 million shillings at 10%, giving a net interest cost of 4 million shillings. The movement in the defined benefit obligation starts with the opening obligation of 400 million shillings, adds current service cost of 28 million shillings, an interest cost of 40 million shillings, deducts benefits paid of 20 million shillings, and adds the actuarial loss of 15 million shillings. This results in a closing obligation of 463 million shillings. The movement in plan assets starts with 360 million shillings, adds expected return of 36 million shillings based on the discount rate, adds contributions of 25 million shillings, deducts benefits paid of 20 million shillings, and recognizes a remeasurement loss of 4 million shillings, because the actual return was lower than expected. This gives closing plan assets of 397 million shillings. The net defined benefit liability at the end of the year is therefore 66 million shillings, being the difference between the closing obligation and the closing plan assets. In profit or loss, Delta Limited recognizes current service cost of 28 million shillings and net interest cost of 4 million shillings, giving a total expense of 32 million shillings. In other comprehensive income, the actuarial loss on the obligation of 15 million shillings and the remeasurement loss on plan assets of 4 million shillings are recognized, giving a total OCI loss of 19 million shillings. This clear separation between profit or loss and OCI is essential for full marks. In summary, IAS 19 is not merely about calculations, but about correct classification, disciplined presentation, and a strong understanding of why certain items affect profit or loss while others affect other comprehensive income. At CPA Advanced Level, mastery of employee benefits comes from combining conceptual explanation with structured numerical workings, exactly as we have done in this session. Have a